Want to really get a handle on money and banking, specifically how it works here in Canada, but without wading through super dense textbooks.
Yeah, think of this as a quick tour through the absolute essentials. We're cutting through some of the noise.
Exactly. We're looking at some key bits from university-level intro materials for a money and banking course, specifically tailored for Canada.
And our mission today is really to build that foundation. Why should you care about financial markets, these institutions, monetary policy in Canada?
Get some of the key terms down, right?
Absolutely. Get the language right.
Okay, so let's dive right in. Financial markets in Canada. Why are they so important?
Well, fundamentally, they're about moving money. Simple as that. They channel funds from people or businesses that have, a surplus.
Savers, basically.
Savers, exactly, to those who have a shortage, who need funds for investment or spending.
And that directly impacts, well, everyone, right? Individuals, Canadian businesses, the whole national economy.
Definitely. And one of the biggest ways this happens is through the bond market.
Okay, bonds. So what are we talking about here? What's its security, first off?
Good question. A security is basically just a claim on the issuer's future income or assets.
Right.
And a bond is a specific type of security. It's a debt instrument. The issuer promises to make payments for a set period.
Okay, so like an IOU, but more formal. And interest rates come into play here.
Big time. The interest rate is essentially the cost of borrowing that money. Or you could think of it as the price paid for renting funds.
Usually as percentage, yeah. Like if I lend the Canadian government $100 at 4%, I expect $104 back.
Precisely. And our source material has this interesting figure 1-1 showing various Canadian bond rates from 1977 right up to 2020.
And looking at that chart, you see they kind of move together, but not perfectly. There are gaps. What causes those differences in borrowing costs for, say, a government bond versus a corporate one in Canada?
Well, several things. Risk is a huge one. Government of Canada bonds, generally seen as very low risk, so they tend to pay lower interest. Corporate bonds have more risk. The company could struggle, so they typically have to offer higher rates to attract lenders.
Makes sense.
And also the term, the length of the bond. Longer-term bonds usually carry higher rates. There's more uncertainty over the longer period, inflation risk, things like that. Investors need compensation for locking up money longer.
Okay, so bonds are one piece. What about the stock market? We hear about TSX all the time.
Right, the stock market. So a stock isn't debt, it's ownership. A share represents a little piece of a Canadian company.
Like owning a tiny fraction of, I don't know, a Canadian bank or a tech firm.
Exactly. And owning that stock gives you a claim on the company's earnings and assets. The stock market is just the place where these shares, these ownership stakes, get traded.
And the price, the stock price, what drives that? Is it just how well the company's doing right now?
That's part of it, definitely. Current performance matters, but maybe even more important is what investors think will happen in the future. Expectations about growth, profitability.
Future potential.
Yes. Within Canada, and maybe globally too, depending on the company, that's why you see stock prices swing so much on news or economic forecasts. And those swings, they actually influence real decisions by businesses here in Canada about investing and expanding.
Right. And figure 1-2 in the material shows that volatility pretty clearly for the S&P TSX Composite Index over, 60-plus years?
Yeah, it's definitely not a smooth ride.
Okay, so we have the markets, bonds, stocks. But who actually helps make all this happen? The institutions, right? Banking and financial institutions in Canada.
Crucial players. Our source really stresses their role. They're the ones actively channeling the funds, connecting the savers to the people with productive investment ideas. They make the markets work efficiently.
The intermediaries.
Exactly. Financial intermediaries, they stand in the middle. They borrow from savers, maybe by taking deposits, and then lend to borrowers.
And in Canada, who are the main types? Obviously, the big banks.
The chartered banks, yes, they're a huge part. But also trust and mortgage loan companies. And don't forget, credit unions and cases populaires.
Right, the member-owned ones. Often very community-focused here.
Very much so.
But it's broader than just those deposit-taking institutions, isn't it?
Oh, absolutely. There's a whole ecosystem. You've got insurance companies managing risk, finance companies maybe for car loans or business equipment.
Pension funds.
Huge players managing retirement savings for millions of Canadians, mutual funds pooling money from lots of small investors, and investment banks who help companies raise capital, issue new stocks or bonds.
It's a complex system. And it's not standing still either. The source mentions financial innovation, e-finance, Technology's changing things here, too.
Constantly. Innovation means new products, new services. E-finance is just delivering those services electronically. Online banking, mobile payments, robo-advisors.
All that stuff makes things more efficient, I guess.
It can, absolutely. Lower costs, better access for people. But there's a flip side. Innovation can sometimes create new risks, things regulators haven't caught up with yet. We've seen how that can sometimes contribute to instability. Think about new digital lending platforms maybe not having the same oversight as traditional banks initially.
Which naturally leads to regulation. Why does the government get involved in regulating finance in Canada? Is it just red tape?
Not primarily. The big fear, the main reason for regulation is something called contagion.
Contagion, like financial sickness spreading.
Sort of, yeah. If one major Canadian bank, say, gets into trouble because of bad loans, and other banks have lent money to that bank or hold its debt, the problem can spread.
Like a domino effect.
Exactly. It can ripple through the whole system, hitting parts of the Canadian economy that seem totally separate. So regulation aims for safety, soundness, keeping the system stable, plus promoting competition and efficiency, ideally.
But even with rules, things can go wrong. Financial crises, they still happen. The source mentioned the 2007-08 U.S. crisis. That hit Canada too, didn't it?
It did, though perhaps less severely than the U.S. But yes, financial crises are these major breakdowns. Asset prices plummet, companies fail, financial and non-financial. It's a recurring pattern, unfortunately. And that U.S. crisis, starting with subprime mortgages, really showed how interconnected global finance is and how problems can spread internationally, impacting markets here.
Okay, markets, institutions. Let's switch gears to money itself. In the Canadian context, what is money, fundamentally?
At its core, money is just anything that's generally accepted as payment. Payment for goods, services, or settling debts within the Canadian economy.
So the loonies and toonies in my pocket, my debit card.
Yep. And it's absolutely vital. It affects almost everything in the business cycles, inflation, interest rates. That's why we have monetary policy.
Which is managed by
The Bank of Canada, our central bank. Monetary policy refers to the actions they take to influence the economy, mostly by managing money and credit conditions.
So money isn't just for buying coffee. It has specific jobs to do in the economy.
That's right. The source highlights three main functions. First, it's a medium of exchange.
Right?
Makes buying and selling way easier than trying to barter, trade chickens for haircuts.
Yeah, Jimmy.
Second, it's a unit of account. It gives us a common yardstick to measure the value of everything in Canada. How much is a car worth versus a house? We use dollars.
Okay.
And third, it's a store of value. You can hold money to spend later, although inflation can erode its value over time, right?
Good point. So the Canadian dollar, what actually backs it? Is there gold sitting in a vault at the Bank of Canada?
Not really. Not in the sense that you can trade your dollars for a fixed amount of gold anymore.
Yeah.
That's a commodity-based system, which we used to have historically.
Right.
But Canada, like most modern economies, uses a fiat money system. It's paper-based,
Right.
essentially. Its value isn't tied to a physical commodity.
So what gives it value then? Just faith.
Pretty much. It boils down to confidence and credibility. Confidence that other people in Canada will accept your dollars as payment,
Yeah.
and credibility in the institution issuing it, the Bank of Canada.
So things like a stable government, an independent central bank, those help build that faith.
Absolutely critical.
Okay. Now, economists are always talking about the money supply in Canada. What does that mean exactly?
It's the total amount of money circulating in the Canadian economy, but it's not quite as simple as one single number.
No.
No, the Bank of Canada actually tracks several different measures. They have labels like M1 plus com, M1 plus plus plus, M2, M2 plus 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 plus, M3, ranging from narrow to broad definitions of what counts as money.
Wow. Okay. Where can people find out what those mean?
The Bank of Canada's website has great explanations. It's a really useful resource. But the key takeaway from our source is that the bank tends to focus most closely on M1 plus plus plus.
And 1 plus plus, what's included in that one?
M1 plus plus is basically currency outside banks, plus all checkable deposits, and also non-checkable deposits at banks, trust companies, mortgage loan companies, and the credit unions and Casas Populaires across Canada. So it's the most liquid stuff money that's readily available for spending.
Got it. So how does the amount of this M1 plus plus stuff relate to, say, recessions or economic booms in Canada, these business cycles?
Well, business cycles are those ups and downs in overall economic activity we experience here. They affect the unemployment rate, the percentage of the Canadian labor force without jobs but looking for work, Recessions are the downturns, typically defined as 2 straight quarters where the economy shrinks.
Right.
And Figure 1.3 in our material looks at the growth of M1++ versus Canadian business cycles. It suggests that often, not always, but often, a slowdown in money growth happens before a recession hits.
So potentially a leading indicator.
Potentially, yeah.
Yeah.
But not a perfect predictor by any means. The relationship isn't always tight.
Okay. What about inflation? The rising cost of living in Canada that we hear so much about. How does money supply connect there?
Inflation is that sustained increase in the overall price level, the average price of stuff Canadians buy.
Groceries, gas, housing.
All of it, yeah, measured by things like the Consumer Price Index, CPI. And the source shows a pretty strong link historically between how fast the money supply grows and the rate of inflation. Figure 1-4 shows this for Canada, and Figure 1-5 even shows it comparing different countries.
So generally, more money growth often leads to higher inflation.
That's the general tendency observed over long periods, yes. Too much money chasing too few goods, as the saying goes.
And the last big piece, interest rates in Canada. We talked about what they are. How does the money supply affect them?
Historically, looking at Figure 1-6, there was often a connection. When money growth was high, long-term interest rates on Canadian government bonds tended to be higher too.
Okay, why is that?
Well, one reason could be inflation expectations. If rapid money growth leads people to expect higher inflation, lenders will demand higher interest rates to compensate for the loss of purchasing power.
Ah, I see.
But the source does caution that this link seems to have weakened or become less clear since about the year 2000. Other factors, maybe global capital flows or central bank actions, seem to be playing a bigger role in driving Canadian interest rates more recently.
Interesting. Now, the Bank of Canada handles monetary policy, but the government has tools too, right? Fiscal policy.
Right. Fiscal policy is the government's side decisions about government spending and taxation in Canada.
So if a government spends more than it takes in taxes, that's a budget deficit.
Correct. And if it takes in more than it spends, that's a budget surplus. Figure 1-7 in the source actually charts Canada's budget balance as a percentage of our economy, or GDP, over many decades.
Okay, we've covered a lot on the domestic Canadian front, but Canada doesn't exist in a vacuum. International finance. Why is that increasingly important for us to understand?
Oh, hugely important. Financial markets are just so much more globalized now. Canadian companies borrow money overseas. Foreign companies borrow here.
Capital flows across borders.
Exactly. And our own Canadian financial institutions operate internationally much more than they used to. Think of the global reach of Canada's big banks. This interconnectedness means what happens elsewhere affects us, and vice versa.
And a huge part of that is the foreign exchange market,
Yeah.
right? Trading Canadian dollars for US dollars or euros.
Precisely. The foreign exchange market is where currencies are traded, and the exchange rate is simply the price of one currency in terms of another.
Like today, maybe it costs, say, 80 US cents to buy 1 Canadian dollar.
Right. So the USD SAD rate is 0.80. Now, if next month it takes 82 US cents to buy a Canadian dollar, we'd say the Canadian dollar has appreciated. It got stronger against the US dollar.
And if it only took 78 cents?
Then it depreciated, got weaker. Figure 1-8 shows how the Canadian dollar has fluctuated against the US dollar going all the way back to 1971. Lots of ups and downs.
And those exchange rate moves, plus the flow of investment money across borders, they have real impacts here in Canada, don't they?
Absolutely. Affects import-export businesses, inflation, investment decisions. It's a major factor. Further study would get into things like different exchange rate policies, capital controls, international bodies like the IMF, and how they all interact and affect Canada.
Okay. Lastly, the source mentions the approach for studying all this. It talks about an economic way of thinking, specifically for understanding Canadian money and banking. What's that mean?
It just means using a consistent framework, applying basic economic ideas like supply and demand, thinking about how markets reach an equilibrium, understanding that people and firms usually respond to incentives, often trying to maximize profit.
Using simple models to understand complex things.
Exactly. Simple models, looking at real-world Canadian case studies, keeping an eye on current events, and using the web resources we mentioned is key for digging deeper yourself.
Statistics Canada, the FRE database for data, the Bank of Canada website.
All invaluable. And that suggestion to think about the role of financial intermediaries here in Canada, that's a perfect way to start applying these ideas yourself.
Great. So just to wrap up this deep dive, we've really laid the groundwork. We've seen why financial markets, institutions, money itself, and the international connections are all vital, particularly in the Canadian context.
Yeah, hopefully it provides a solid base. understanding how funds flow, who the key Canadian players are, what money does, and how we're linked globally. It's all interconnected.
It really is. Okay, so to leave you with something to think about, we saw that chart showing the Canadian dollar's ups and downs against the US dollar. Given that volatility, what do you think is the single biggest headache for a Canadian company trying to do business internationally?
That's a good one. And related to our earlier chat about money supply, given the Bank of Canada focuses on M1++ wall, what factors do you think really move that specific measure around in the Canadian economy day to day or month to month? Something to ponder. Definitely check out those web resources if you want to explore further.